Welcome to the Organized Investor Podcast with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. Think of these pod classes as a college of knowledge, and the curriculum is an inside look at how we work with our clients to organize their investments, their retirement, and their affairs. Our process is certainly not the only approach, but it has served our clients well. Listening may materially improve your life as well, but for that to happen, it also takes an open mind, an interest to learn, and your trust in what we're sharing. We focus only on what is relevant and will explain things several times in different ways over multiple classes to ensure you understand their importance. We suggest you subscribe so you'll receive reminders about the next class. And with the tools and information on our website, theorganizedinvestor.com, you can start getting organized right now.
Welcome back, students. It was 12 months ago, back in August of 2024, when we recorded PodClass number 24. And here we are about a year later, September of 2025, and this is PodClass number 25, or as we call it, the Track Record Update. Unlike anything your own financial advisor would ever do, we're about to give an update on how much our clients have improved their long-term financial future over the last year. Now, during the first 8 months of 2025, the 215 accounts we were managing on August 31st had an average net rate of return of 28.4% for those 8 months. This was more than 4 times the return of the Dow Jones Industrial Average, which grew only 7.1% during the same period.
And Megan, through August 31st, our 5-year track record is now up to 16.6% per year, which is over 6% better than the Dow Jones average. Now, there's a lot of reasons why people don't even know their own 5-year performance track record for their own money. But one reason is maybe their advisor is too embarrassed to tell them. So if you have an advisor, I would guess one way or another, you're probably paying them for some type of advice. But is that advice, is it really of much benefit to you?
I'm Megan Hubbard, along with my dad, Jerry Goodman, and students, we're glad you're able to join us today. I'm a former first grade teacher at the Christian Academy of Knoxville, and I have a master's degree in curriculum and instruction. I'm here with my dad, Jerry Goodman, who graduated in accounting from Tennessee, was on the professional staff of Price Waterhouse, and was the comptroller of Wendy's of Knoxville. He was also a vice president at Merrill Lynch and is a CFP with 43 years of experience. And also, like I said, he's my dad, so he's got lots of experience with that.
You got that going for you, Megan. So, I was actually, as you know, Megan, I was at Merrill Lynch for 17 years. And if you heard me say this before, it was the happiest 3 years of my life. But anyway, pod classes 4, 5, and 6, way back when we recorded those, that is where we were talking about organizing your retirement and really just how to know if you have enough money saved for that time in your life. Podcast 23, that was all about organizing your affairs and the importance of estate planning documents, all of that. While retirement planning and estate planning, we will say they're both important. Don't misunderstand us. But neither one of those, retirement planning or your retirement planning or estate planning, neither one is going to help you materially improve your financial future like your investments can.
So let's start this podcast off with a sports analogy to make a point, okay? So regardless of which sports team you can think of, I'm a Vols fan, but if you're not, that's okay. We can still be friends. They all have coaches, and these coaches are hired and fired every year based on their performance. I think we could all agree on that, no matter whose team you're cheering for. With the biggest part of performance related to their actual track record, that's what their, tenure at a job is, right? So in other words, what are their wins? What's their losses? What's that ratio? What does that look like for a coach? And if they lose more than they win, they're probably not going to have a job for very long, right? And the replacement has probably been winning more than losing if they hire somebody new to come and take over their position.
So let's assume for a moment that you have a financial advisor, and we're going to refer to them as your financial coach, okay? Because this is a sports analogy that Megan started. Now, you may have had this financial coach for decades, but we would be shocked if they've ever told you what the performance has been for the book of business, okay, for their many clients. And we're not just talking about your performance. We're referring to the core group of clients that they work with, okay? So have they ever shared the rates of return for these clients that they coach? Of course they haven't. And in fact, they may not even know the answer to that question if you were to ask them about it.
Now, if you don't know their overall track record, and particularly if you don't even know what your own performance has been, how do you decide if they're doing a good job or a poor job? How do you know? And so your financial coach may be a great guy. Okay. We'll give you that. Might be your best friend. But, if you've known them for years, even, you still need to talk to them about the financial future piece here. This is not a personality contest. This is a time to look at your finances and think about your family and your financial future, not just be concerned about friendships.
Exactly. So even though they're not going to share their track record with you, we're going to share ours. In fact, here's something else that your advisor has never done. On the investments page of our website, theorganizedinvestor.com, just go to that website. You're going to find our 10-page summary listing that shows it's 6 2/3 years, which is equivalent to 80 months. 80-month track record, which covers, that period of time. Now, this shows the historical performance of 215 accounts that we manage for clients, which is after any kind of fees or associated costs related to managing those accounts, okay? And our track record and these returns are, again, as of August 31st, 2025.
So again, year to date, which is the first 8 months of 2025, I'm really thankful that I didn't have to talk about this as a fraction like he just did. I hate fractions.
Look at your friend, Megan.
No, worst thing to teach children is fractions. Anyways, PTSD over fractions. So I'm going to talk about it as, the last 8 months of 2025, all 215 of our accounts had an average return of 28.4%. Now, the Dow returned 7.1%, so we're 4 times that number, okay? Or 21 percentage points higher than the Dow Jones Industrial Average. And to be clear, that was a 28.4% increase in actual value in just 8 months, not an annualized rate of return for the first part of the year, okay? So as you would expect, our clients they're really happy about this, right? How could you not be? For the trailing 1-year period, our average net rate of return was actually 26.6%. So the Dow was up 9.6%. So we were up almost triple what the Dow returned over that 12-month period.
So for the trailing 3-year period, we had an average return of 17.7%, which again exceeded the Dow by more than 4 points. The 5-year trailing track record is now up to 16.6%. which is 6 points better than the Dow. And again, as Megan referred to it, the 80-month track record is also at 16.6%, which is again more than 6 points more than the Dow for that period. So in addition to this 10-page summary that's on our website, we even have more boring information if you really are interested in seeing it, okay, to give you more documentation if you just kind of have a need for more info. And to summarize all of this, here's the gist of this. Our performance is substantially higher than the Dow Jones Industrial Average, which we're going to call the Dow. And it's common to see that most investors that we run into have returns that are substantially lower than the Dow.
Now, granted, past performance does not guarantee future results, but our track record gives you a point of reference and it helps validate what's possible in terms of materially improving someone's financial future, okay? So for years, we've used the example that if you can improve your overall performance by just 2% per year, $1 million portfolio would realize an additional $20,000 per year, which is equal to about $400,000 over a 20-year period. That is not a small amount of money to scoff at. Most would agree that this is going to materially improve your life, right? That's a large piece of money. Now, when you consider our track record, we've actually substantially exceeded that 2% goal for every time period. So even though we just randomly selected this 2% goal, we're proud to say that our clients have actually done better than that.
Now, let's go back to your own situation. If you, the listener, if you really don't even have a clue about what your own 5-year net rate of return has been for comparison, let's give you a little something that may help you make a comparison. If you assume that our 5-year track record of 16.6% per year, If you assume that and just ignore income taxes for the moment, just the 16.6%, in 5 years, $1 million investment will grow to $2.2 million. Okay? It's a lot of money. And in other words, it's going to more than double in 5 years. So here's a question. Did your investments double in value over the last 5 years? Or did they even come close? See, if your financial coach has you in some fee-based account that's invested in either mutual funds, exchange traded funds, maybe even annuities, without even looking at your information, we would expect that your 5 year rate of return has probably been around 8.5%, just as a guess. And that's just a wild guess, but assuming that's true, just for the sake of discussion, then our 5 year track record of 16.6% is almost twice that.
Now, if you really don't know what your 5 year track record has been, give us a call and we'll actually help you figure that out. We'll discuss all that with you. We can probably give you a pretty good guesstimate, if you will, just by reviewing the statements that you have from your current investment firm. If you ask most people what's most important to them, the answer usually revolves around having enough money. And a lot of advisors may have the most logical sounding strategy on the planet, but how well has it actually done? In simple terms, a higher rate of return leads to having more money. It's pretty simple.
Exactly. I would guess most of you have TVs, although some people don't watch TV much anymore. But if you look at TV commercials for all of these large investment firms, what you're going to realize is they offer pretty much the same products and services across the board. Now, when you look at a lot of investment statements like we do, because people send us their statements to review, they want to get some feedback, we will notice that most advisors make very similar recommendations and are getting these same similar mediocre results, okay? See, we're explaining our process, which is dramatically different than most advisors, and our performance shows it. Granted, there's more to financial planning than just how much money you make, okay? But money can fix a lot of problems. And one of my favorite sayings is, Megan, I've never been in a situation where having money made things worse, okay? And I thought that for a long time, and it's really pretty darn true.
So the 80-month track record on the investments page of our website is our scorecard of just how much our clients have materially improved their long-term financial future. The rates of return for each account can vary depending on the client's investment objectives and tolerance for risk, obviously. But regardless of what the coach of the sports team says, if they have mediocre performance, they're probably going to be replaced.
So in reference to your financial coach and what they tell you, performance is still the ultimate yardstick in terms of measuring success. It's odd that most people would never even scrutinize their financial coach, though. That's really kind of strange. And they won't even question really anything the advisor may say. They'll just kind of go along with it.
And yet their advisor is the person who can affect what someone's financial future looks like. But seriously, is their advice doing you much good? You need to ask yourself that question. And if you're making mediocre returns, why do you need the advisor? You can just do it yourself and get mediocre returns.
Sadly, that's pretty true. And for various reasons, most clients have never, ever, 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 ever had a second opinion from another financial advisor, okay? And since they really don't have any other options, they're suffering from what we call, Megan and I refer to as the stale potato chip syndrome.
I love potato chips. I don't like stale ones, though.
Well, yeah, exactly. And this means that basically someone that, if they only had a stale bag of potato chips, they had nothing else to choose from, guess what? They're going to eventually eat that stale bag of potato chips, okay? It's going to eat them because they don't have anything else to pick from. If they had a better option than stale potato chips, yeah, they'd probably eat those, but they don't.
Yeah, nobody likes a stale potato chip. But if you get hungry enough, I guess you'll eat anything, right?
Yep.
So we know this is a really strange example, but we also love food in our family. So bear with us. We love a good food analogy. But it's all about having more choices, okay? Which is what we're offering you in this podcast. Your favorite sports team pays attention to the track record of its coach, I promise you. And you should be paying attention to yours as well when it comes to your finances. We're explaining what we do as another option to consider. And the best way for you to actually make an informed decision is by listening to what we're explaining and to eventually have a chat with us. At that point, you're going to know how much room you have for improvement, okay? So you can just keep munching away on your bag of stale potato chips, or you can take a moment to see if what we're doing might be a better option. And it doesn't obligate you to do anything, but it doesn't hurt to have another option.
You're quickly climbing the learning curve by listening to our Organized Investor podcast. Your instructors are Megan Hubbard and her favorite dad, Jerry Goodman. Listening to at least 12 pod classes is recommended, and it also helps to subscribe on your podcast platform.
We've said this before. We're proud that how we've been able to help our clients. So let's explain the process on where this 2% of improvement is coming from. So here's a one sentence summary. It's like our little elevator speech. 1% is expected from lower fees and costs. The other 1% is from better performance by simply being more selective with the investment choices. So in other words, there's fees and that may be too high, costs that may also can be avoided, and the actual investment performance may be able to be improved. So in terms of fees, most people are invested with an advisory account with some advisor and are probably being charged a fee to manage those accounts.
So we also use advisory accounts, but the advisory fee we charge is usually about 0.25% less than, what other advisors will charge. There we go again with fractions.
Your favorite.
For anyone who considers Charles Schwab to be economical, our advisory fees are actually less than theirs, okay? So based on our impressive performance, we could double what we charge and our clients would still be super happy. But we don't because we subscribe to the do unto others mantra with our clients.
It's a great mantra. So in terms of reducing cost, we try to avoid mutual funds, exchange-traded funds, annuities, alternative investments. There's all sorts of things because they can add another whole layer of internal cost that many times can be as much as 1% per year. Now, we look at a much better option, which we feel is higher quality individual common stocks with a history of raising their dividends. There's no internal cost to own these stocks. They're much more transparent than owning a mutual fund, and you can be much more selective with what you own. So we have more to say about all these fees and costs in a minute. But to be clear, saving 1% in fees and costs, it depends on how you're currently invested. And you can either realize those savings or you won't.
So the third leg of this stool is actually improving your actual investment performance. It's not as predictable as fees and costs, but it offers a tremendous amount of opportunity. We find that mutual funds, exchange-traded funds, even alternative investments may have mediocre returns. So owning 20 mutual funds that are invested in several hundred stocks each, that actually means that you may own 3,000 to 4,000 companies. That's a lot of companies. That many companies actually means that you've gone from diversification, which is such a buzzword in our industry, to diversification.
Dun,
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 dun, dun.
dun.
We had to add our little sound effect there.
Our favorite term, diversification.
Diversification, because you effectively now own most every stock on the planet. You're over diversified. You own the good ones, but you also own a lot of the not so good ones. So fees, costs, and investment performance is where we usually find the 2% improvement that we have for our goal.
So we're now going to explain what we actually do, which makes things kind of weird, but which is also what most advisors don't do in terms of how we manage all of this. First and foremost, we said this a minute ago, we invest in actual common stocks, and most advisors don't do this. Your advisor probably has you invested in either mutual funds, exchange-traded funds, alternative investments, unit investment trusts, annuities. I mean, there's a long list of things that they may have your money squirreled into. And we have two different approaches with these common stocks. The core strategy includes higher quality common stocks with a history of raising their dividends. Very profitable, not terribly exciting, but does very well. We call this dividend growth. And these are usually from what's called a DSIP list, which is a very high level research list from Wells Fargo Research.
So this list actually has a 30-year track record of 12.8% per year, which was about 1% more than the S&P 500 index over that same period of time. These are generally large, well managed companies like Costco, Home Depot, Walmart, Becton Dickinson, Lowe's, Schmucker's Jelly. This is just to name a few. And actually, as I name those, like I'm sitting here thinking I've either shopped in one of those stores over the past week or I've eaten Schmucker's Jelly, had it for dinner last night. So I'm assuming that you guys are probably the same as a listener. Um, you're you're investing in these companies just day to day as well. Some of these companies have actually raised their dividends every year for over 60 years, which actually indicates they're very well managed. And that's one reason why they are generally less volatile than many other parts of the stock market. Now, much of the time, the account will have 2% invested in about 49 of these dividend growth companies, like the ones we just mentioned. So, again, this is our core holding that actually provides a nice dividend that has been increasing, as well as a lot of price appreciation, which actually explains the 12% return over the last 30 years.
So the other approach in terms of common stocks is invested in what we refer to as bargain opportunities. And these little bargain opportunities are going to occasionally occur in the market. Now, these are usually triggered by some random event that sends a shock wave through the stock market. And these events are typically going to be temporary in duration. They don't last forever. Now, our very, very favorite of all times bargain opportunity, spring of 2020. Guess when that was? Basically, during COVID, we moved a lot of money into this out of these boring dividend growth stocks that had not dropped much in value into companies that had been affected by COVID. So instead of 2%, we reduced the holdings of those dividend growth stocks down to about 1% of those same 49 companies, if you will. And we reinvested those funds into 1% each of about 49 other companies that, again, were affected by COVID in a very significant way.
So the list actually included things like hotels, restaurants, casinos, airlines, cruise lines, aerospace, credit card companies. We could keep going. There are many other examples. It was virtually anything that was travel or hospitality related and that had dropped significantly in price in the spring of 2020. Now, at this point, the account effectively had about 1% invested in 98 different companies. And as long as there weren't a lot of bankruptcies, which there were none, this was going to be a profitable investment decision, which it actually turned out to be.
It was a lot of fun. So bargain opportunity. That's when we moved a portion of the accounts into 13 regional banks back in 2023. And that was because several banks out, I think most of them out west, had gone bankrupt simply because the sharp rise in interest rates, it put them out of business. So this was on a smaller scale than the COVID opportunity, but it still ended up being very profitable. I mean, when you consider the amount of money that was involved.
Then we have bargain opportunity number 3, which actually related to focusing on some of the tariff affected parts of the market, which occurred in the spring of 2025, just a few short months ago. At the time, we had a lot of available cash that we moved into these undervalued areas, as well as from other stocks that we owned that were not affected. Part of what makes our process so different and our performance so much better is that we have the ability to manage these accounts on a discretionary basis, which gives us the flexibility to actually make changes very quickly.
This is a little these tariff announcements that were triggered around the end of March, 1st of April. These caused one of the largest overreactions in the history of the stock market. It was incredible. So on April 3rd, we executed a total of 12,521, down to the last number there. That many trades, over 12,000 trades, with basically a few days of the market being low, the market low in April. Since then, we've continued to make some adjustments as we try to be more selective with where this money's all invested. So this is why our average performance is over 28% for the first 8 months of the year, and why it's over 4 times more than the Dow Jones Industrial Average.
So these are just 3 examples of bargain opportunities that, will periodically and unexpectedly occur in the market. And the next one will be different than all 3 of these. And, obviously we don't know what that is, but we will be watching for those. Once these temporary opportunities are over and done with, we'll migrate back to our core strategy. And being able to be very selective and manage these accounts on a discretionary basis without transaction charges is what allows us to make these returns possible. So, compared to mutual funds, ETFs, stocks are also more transparent and they're going to give you better control over your taxes. Just another benefit of our strategy that we use here.
See, we're able to explain our process in what seems should be a rather simple way. But you have to understand, it took us years to figure out how to do this for hundreds of accounts involving tens of millions of dollars. See, very few financial advisors either have the expertise or simply want to take the time to manage a portfolio this way. They will typically allocate your money into 15 or 20 things like mutual funds, exchange traded funds, maybe alternatives or annuities. And in fact, many advisors, they'll even delegate the investment selection to another part of their company. So, in a sense, they're nothing more than a salesperson being paid to talk you into doing things.
And here's a couple of examples of commonly used strategies we'll avoid because they can have high costs and mediocre performance. For the first one, on the investments page of our website, there's a summary of a mutual fund advisory program called FundSource. It's dated June 30th, 2025. And on page 5, it actually shows the performance of 9.85% for the past 5 years. And if you assume a 1% advisory fee where fees were deducted, the 5-year net rate of return is down to 8.85%. Our 5-year net rate of return has actually been 16.6% per year, which is almost double the return of FundSource. And part of that difference is because there's a 0.78% internal cost shown on page 7.
So, what Megan's talking about means what she's referring to is that someone with $1 million in this mutual fund model, they're basically being charged $7,800 per year in internal cost, which is equivalent to $156,000 if you extrapolate that over a 20-year period. Now, I would just take a wild guess. There are hundreds of billions of dollars, maybe a couple of trillion even, invested in different versions of these mutual fund advisory programs that are spread across the entire investment, all these investment firms in this country, okay? This is, and the most common trait is they're going to have high costs and what we see, mediocre performance.
Now, the second example is actually something we avoid, which is alternative investments, like the Blackstone Real Estate Trust. There's a copy of their summary on our investment page as well on our website, and it actually shows as of June 30th, 2025, the 5-year track record of this Blackstone investment was 10.4%. Now, if you assume an advisory fee of 1%, the net return would be down to about 9.4%. While this is not terrible performance, by comparison, again, our 5-year net rate of return is 16.6%, which is much higher.
Keep in mind, alternative investments can be complicated and they can have a much higher cost than even mutual funds. And Blackstone, the way you can get into it easily, but it may take you up to 5 years to completely withdraw your funds, which makes it pretty illiquid. And it can also complicate your tax return, which can increase the fee to the CPA. Now, advisors like to refer to Blackstone as a private equity investment, as if there's some sort of guarantee, some sort of specialty aspect of that that's going to give you fabulous returns. But that really hasn't been the case.
Now, we really don't need another reason to avoid mutual funds, ETFs, and alternative investments, but here's one anyways, okay? So again, on the investments page of our website, we'll reference that a lot. Near the bottom is a summary called Pay to Play. This explains the financial relationships that actually exist between most investment firms and the products and service companies. We've included the web links actually to the public disclosures for your reading pleasure. These firms have to post these, and it provides an inside look at the payments that are actually flowing between these companies.
See, some of these investment firms, they will openly admit in these disclosures that they will not even include investments like, say, mutual funds or annuities. They won't even put them on their platform unless those firms receive money back from those same companies, okay? This whole process, Megan called it's called pay to play because the product and service companies have to pay to have their investment products to be available at or maybe even recommended at these investment firms. And some of these disclosures, if you read through them, are going to include the term many times you'll see conflict of interest.
So, what should you be concerned about if this is your investment firm and it's making decisions in the best interest of your of their clients, or are they making decisions based on which product and service company is sending them the most money? This is where possible conflict of interest actually comes into play. And it's just one more reason why we try to avoid advisory programs invested in these mutual fund and ETFs. The bottom line, if you're invested in a firm's mutual fund advisory program, reading this disclosure information actually may cause you to question if the investment firm is making decisions to benefit you or to benefit themselves.
See, all these large investment firms, they all perform basic administrative tasks. Like they'll send out statements, they'll hold assets, they'll offer some level of advice. They'll all have kind of rather similar investment options. So there is this massive amount of sameness that engulfs all of these firms. And regardless of what they say they're going to do, regardless of what your own advisor said they were going to do, what did they do?
So you're paying for advice. Okay. And one way or another, I would expect that your advisor is actually receiving some type of compensation from you having an account with them. That makes sense, right? They have to get paid somehow. So whatever you happen to be paying them, what are you getting in return? Are you paying them a fee only to have them put you in a mutual fund advisory program that also has internal costs and fees and that also has mediocre performance? That doesn't really make sense.
For somebody needing advice, what an advisor may recommend can depend on a couple of things: their level of experience, maybe the investment options that they have, or really their desire to be compensated. That could be part of this, but also their willingness to actually put forth a little time and effort in this whole process. So it's been our experience that the vast majority of advisors are going to transfer the actual investment management to somebody else because either they're not comfortable making those decisions or they simply don't want to spend the time on it. So to put it very bluntly, they're basically, again, we referred to this earlier, they're a salesperson being paid to make investment suggestions, and that's going to give their clients impression they're actually doing something.
And making comments like that may cause someone to say something like, well, but my advisor is a great person. But we'll repeat our earlier comments that this is all about your financial future. It is not a personality contest. We have a process that for some will have potential long-term benefits that will literally total in the hundreds of thousands of dollars. So with all due respect to your advisor, if you're hoping they will ever offer these same pieces of advice and suggestions, now's probably a really good time to lower that expectation.
I love that term.
Your potential benefit from what we're explaining depends on how your investments are currently being managed and if there's room for improvement. It also depends on you taking some time to understand your own investments, and we're happy to help you with that without any cost or obligation.
We said earlier that the very few people can tell you what their 5-year track record has been. In fact, there's very few advisors who can actually tell you what the 5-year performance has been for their clients as a whole. They just don't pay attention to it. They don't discuss it. And Megan, I guess if we had lousy performance, we probably wouldn't be talking about it either, would we? Now, we realize and recognize that, yeah, great performance and materially improving the lives of our clients. That's not the only important thing that we do. It isn't. But our clients will tell you that for them, making a lot of money and doing really well with their financial future is at the top of their list.
Now, we've spent a lot of time just deciding how to explain all of this. It can be kind of technical and a lot to digest. So we're doing everything we can to get your attention. We're that opportunity knocking at the door, okay? We're trying to lead you to the water, but you'll have to decide if you want to take a drink. You need to take an interest in your own situation and be willing to spend a little time with us. Otherwise, all of this may be just a big waste of your time and, frankly, ours if you're not willing to truly listen to us and understand what it is that we're trying to share with you. Think about your portfolio as a lottery ticket that you already own, okay? Does your portfolio have enough room for improvement to change your financial future? You need to be asking yourself that question. And if you don't know the answer to this, we're happy to help you find out if you have a winning lottery ticket number.
It's a great analogy. So we're getting near the end of this podcast, and we're going to end with a story about Bruce. Okay, I'm not going to give you his last name, but let's just refer to him as Bruce. And we explained this way back in podcast 23. We told you the story about Bruce, and it's a great example that covers probably 80% of everything we've covered in all of these podcasts. So after attending one of our workshops, Bruce walked up and said to me, he said, my goal is I want to have my estate planning attorney, my tax advisor, and my financial advisor. I want them all to know each other and to work with each other to make his life easier. Well, that's exactly what Bruce has now, okay? And the way this worked out, Jared Hubbard, who happens to be my son-in-law, who happens to be married to Megan, he is a practicing CPA on our team. And he's been doing Bruce's tax returns shortly after we first met Bruce.
Now, Bruce actually has an estate planning attorney, and that attorney has helped us on over 100 cases in the last decade. And we're actually well aware of how everything is structured in case Bruce needs to make some changes. And oh, by the way, Bruce probably saved several $1,000s versus working with an attorney on his own. So the estate planning and taxes are pretty straightforward. But what isn't so obvious is how we've been able to help Bruce with the organizing of his investments.
So we explained to Bruce, we need to see your information. We went through it and looked at it. And the single biggest surprise was how much we could save him. It was $9,800 per year. And that was just in advisory fees. Because not only do we charge less than most advisors out there, but some of these accounts that Bruce had, they didn't even need to be an advisory account. Now, keep in mind, this is just from the reduction or the elimination of advisory fees that he was being charged, okay? He didn't actually think, as we were explaining this to him, he didn't think, well, this is not possible. We went through every single account one at a time, explained this one, the next one, the next one, and basically what he was being charged, and just to kind of explain this.
And just so you know, Bruce is a super smart man. He is very good at math. Unlike me, he probably excels in fractions. But he just didn't understand the fees and, what was reasonable for fees or what was even possible. And he had actually trusted his long-term advisors, as most of us do, right? That he was trusting he was looking out for him. And that did not end up being the case. So the $9,800 was just from either reducing or eliminating advisory fees. And since this is an annual savings, when you extrapolate that out over a 20-year period, that's equivalent to almost $200,000. And if that's, not even assuming appreciation, then goodness, that number is just going to grow. So in addition to the advisory fees, we actually showed him the internal costs of the many mutual funds he was holding on to in this advisory account, and also the mediocre performance with those mutual funds that he had basically been, I guess, suffering through without lack of knowledge of it. This was even more financially beneficial than actually reducing the advisory fees when you look at it in a total package.
Mm. And at this point, we don't know what Bruce would have made from this mutual fund advisory strategy he was originally invested in. And who knows? But I will share the fact that his 5-year net rate of return for this dividend growth strategy that we manage for him has actually been more than 14% per year. Okay. The point is, he not only materially improved his financial future that will help him, but also help his family, because that's going to eventually flow down to them.
So Bruce started off wanting his legal, tax, and financial advisor to all communicate with each other, which is exactly what he now has. He didn't even ask about improving his overall performance, but that's what he got, which was just like icing on the cake. I told y'all we love a food analogy in our household. We have lots of happy customers, guys, just like Bruce, and along with their families who will benefit from all of this, either down the road or maybe even now if these ideas make sense for them personally. And helping educate these families of our clients is actually one of several reasons we've created these mini pod classes.
So let's just say this in closing. More than half of the investment statements that people send us and we review, more than half of those are going to have at least a portion of their portfolio that has what we're going to call room for significant improvement. And your current financial advisor is not going to tell you, what can be improved, because guess what? They're the reason you have so much room for improvement. They're the ones that suggested everything that we're talking about in this podcast.
So you can actually send us your information to review by using the upload link on the investments page of our website, www.theorganizedinvestor.com. I think I forgot a dot in there, but don't most of us know it's www. But just in case, it's www.
Do you even need the www anymore?
theorganizedinvestor.com. I don't know. I'm going to have to go figure that out after this podcast recording. Good question. Another way you can get your information to us is you can actually mail it to us. I know that seems very antiquated, but some people still love to put something in the mail. And so that is still an option.
It's slow, nice and slow.
Oh, yeah. They like to help you anticipate what you're going to get in the mail. But our address is actually on the same website that I just referred to, www.theorganizedinvestor.com. Or if you really want to see us in person, we would love that. And you can actually bring your information to us face to face and just chat with us at our office. There's no cost or obligation for a discussion with us. And we look forward to seeing you and actually hearing from you in any of these ways that we just suggested.
And we always remind people, if you come around 10:30, 11 o'clock, it's right before lunchtime when we can have lunch at Aubrey's across the parking lot.
We are not, by the way, getting paid by Aubrey's to
No, we're not. We're not on a retainer. We're not their marketing department. So what we've gone through here, this has been a mouthful, a big fat mouthful of facts and figures. There's a lot to digest, a lot to unwind here and unwrap. We're offering you basically our option that may be a much better option than the bag of chips that you're currently munching on, okay? It's your financial future we're offering to improve, and we invite you to contact us for a chat. It is always, there's no cost, no obligation to have a discussion. And as our little phrase would go, when you explore your options, you get to expand your choices.
So if you've listened to other episodes of our podclasses, you know our favorite part of the podcast is to explain that the returns for each of our clients' accounts can vary based on the client's individual circumstances, such as when they started their account and what their objective was, et cetera, et cetera. The rates of returns for our advisory clients were actually compiled from a month-end performance report for each of the 215 accounts respectively. And we have a lot of boring documentation to back up these statistics. If you're interested in those, if you need a sleep aid, we can provide those for you. This is podcast number 25. So we refer to this as the track record update. If you're on our website, you'll see that reference several times. And it's a refresher on the earlier episodes about organizing your investments. You're invited to listen to any of our podclasses, by the way. To view the video on our website, you can go there as well and see just kind of a short website seminar, if you will. And you're actually able to call us at any time, maybe not at like midnight, but call us anytime with questions that you may have. Also, be sure to follow us on social media such as YouTube, LinkedIn, X, and save us to your favorite podcast player to receive reminders of future episodes. Thanks for listening, and class is dismissed.
Aflac.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or TN Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. The Organized Investor cannot accept trade or account instructions on or through this platform. Please contact us directly at contactus@tnwealthmanagement.com or 865-415-2060 to place a trade or for trade or account-related questions. Brokerage and advisory services are provided by TN Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by TN Wealth Management for educational platform purposes.